Markets shook, signals flashed, and Monday could tip the scales. Welcome to Weekly Market Waves from Investing Angles, where every candle speaks, every Elliott Wave reveals, and we chart the turn before the herd even blinks. This week's lineup is packed. Volatility, cooling down, or brewing something bigger. Candles have the answer. Dollar index. Candles point down, but can technicals argue back? Baltic Dry Index. Will new tariffs ripple through the global shipping pulse? Bond market. Extended review for extended concerns. US yields. The spread's early red flag. 100-year moving average. A signal you can't afford to ignore. TOT. A super call, a super drop. Is the story over or just getting started? Canadian 5-year, a diagonal in motion. Commodities Weekly is in a separate video, link at the end, don't miss it. Stock market focus. Russell. Is the fall done or one wave left to crash? Nasdaq. Big technical damage and a Monday make or break. Dow Jones. A legendary December call. But did the index overcorrect? Joe Transports, echo from the Baltic Dry. S&P 500, massive Monday test. Are the technicals aligned? Sectors and large caps, full read. Global weekly closure. Candles speak from China, Hong Kong, Australia, UK, Germany, Canada, Japan, and India. Special features. Deep dives into Microsoft and JP Morgan. What the charts say next. And as usual, we start with the Volatility Index. This is the daily closure today of the index itself and its futures. So what we are seeing here, why the candles are red, so they were not sufficient to overcome the bullish odds of the previous candle. And most importantly, they closed above the strong support line, 8 days EMA, and both futures and index. And I would like to emphasize this is the recently made bullish cross, 100 by 200 days moving average, and the chances for moving higher are fairly significant. If we look at the weekly frame, so these are strong, big red candles. However, they are not strong enough for a reversal. So these are called incomplete dark cloud cover candles, and they still have a good support. And in order to confirm them, volatility needs to drop significantly in the next week. Whether it happens or not, this is quite a big question. And if we look at some Elliott Wave perspective for volatility, though Elliott Waves are not always very decisive for or very strong for the volatility index, however, some waves are quite telling, and this is the one I believe that volatility just formed. So we are seeing a clear corrective wave down, and most likely it is forming a bullish flag here. Whether it makes one more lower low and moves up or immediately moves up here, this is still a big question. However, the structure suggests that we are not done with the moves upward. And this would be the target, current targets between 63.82, but it can move higher again. So this flag target would be adjusted based on the real closure of the flag. So that's all for volatility. Now let's have a look at the dollar index. So far, we are seeing bearish candles. Dollar is falling, and there is a very good chance that dollar makes another lower low. However, I'd like to emphasize that dollar has been grossly oversold, and on multiple frames up to and including the weekly one. And from historical perspective, dollar doesn't like to be oversold. So technically we may see a very strong reversal, and it might happen very soon. And I'd like to emphasize that the daily candle was completely outside of the Bollinger Band, and this is another alerting signal. So if we see a strong bullish formation, bullish candle in the next couple of days, it could be a strong reversal. Speaking about our all-time frame for Dow Index, the chart remains the same, no changes. What we are seeing here is that potentially Dow completes wave 4, which could also be a bullish flag, and once it is done, we would be looking for a very strong wave 5, which would bring Dow towards 113, 120 target. And the last chart of the day, this is the one that we shared with our subscribers earlier. This was the chart on March 29th when we said that Dow has a very good potential to move down towards these targets, dropping below $100. This is 98 to 95. This is the original target that we were looking. And now with the recent changes, and by the way, this chart was inspired by this textbook example from the Prechter's book. So what we are seeing right now is a possibility for forming a very big wave 4, and by several measures, this would be the most probable targets for the wave, measured by two different Fibonacci ratios and the wave structure. So somewhere between 98.3 and 96, that would be the ideal expectation for the wave to reverse. So that's all for Dow, and now let's move on to the next chapter of our discussion is Baltic Dry Index. We've been tracking this index for numerous years, and it's been helping us to spot big moves for the market, particularly the bearish ones. So this is the chart that we've been tracking for a while, and major events that caused the index to drop. Right now, what we are seeing here is very strong bearish moves on the weekly frames, and I think that these are inspired by tariffs. What I'm seeing here is the 50 over 100 weeks moving average bearish cross. Last time it happened way back in September 2022, and it led to a significant drop in trading activity. And another important signal here, which is circled in blue, is a bearish island, and a fairly clean one. A very strong weekly bearish candle followed by the formation, after formation, and now we are looking for a decline here. And if we look at the bigger frames, so the 10-day frame also closed with a strong bearish candle, and the monthly, it looks like it is on track for a bearish engulfing here. And I also checked quite a few bigger frames. They are also looking bearish. And this is the chart that we made way back in December 2023. And so far, this chart works very nice for us. And this is regarding predicting unpredictable. This is what we did in December 2023 when the index was here at the top, and we said it has a very strong wave bottom, potentially forming a very strong Elliott Wave formation here. So that's about the Baltic Dry Index, and now let's move on to the bond market analysis, which is the most entertaining today. and lots of data points. Let's start with the candles. So these are 2, 5, 10, 20, and 30-year yields. And there are quite a few scary moments here. So first of all, on the weekly frame, 2-year yield, a very strong and entire bullish engulfing. On the 5-day frame and the 10-year, 5-year, and 10-year yields, they have very strong 3 white soldiers. And this is, we know what it means in the candle world. This is mostly the beginning of a bigger, much bigger rally. Speaking about even bigger frames, the 10-day frame and here 10-day frame, what I'm seeing is a confirmation of a bottom. Technically, it's a bottoming pattern. And this is the same. So after a bullish harami, we have a confirmation candle on the 10-day frame, which is twice bigger than the weekly. And we are expecting the yields to march higher. This is another view. Daily, 2-day, and 10-day candles for the 10-year yield. What we are seeing here is the neutral bullish candle on a daily frame, 3 white soldiers, and the bullish engulfing on the 10-day frame. So everything looks very bullish in the yield world. This is another big concern that we've discussed already, and now we have a closing print for the 2-day frame, and I would like to say that both failed to negate this gravestone doji, strong one on the 2-day frame, and right now the odds are bearish. And if you look at the weekly frame, this is most likely a reversal candle. However, it needs a confirmation. Speaking about the daily frame, we have a strong bearish engulfing, a failure, and another bearish candle, which will likely reverse the trend here. And about this chart, we've been discussing it for a while. This is most likely an ending diagonal that is being completed right now. And if this hypothesis holds, then we should see a reversal and the drop below 0 into negative spread, potentially landing here minus 0.53 and 536 in a couple of weeks or months. That's the perspective for the spread. And now let's have a look at the bigger picture. This is the chart that we've been tracking since December 2022. No changes here. The chart remains the same as we discussed it in December 2022. Potentially, this is the very first impulse of the bottom, and now we have a confirmation, corrective wave 2, and we would be looking for another impulse upward. And then another interesting data point here is a 100-year moving average. I need to show it. Yes, the purple line here. This is the annual chart for the 10-year yield. The last time this 100-year moving average, it was crossed somewhere here in 1950, 1960. We don't have the complete data set here. And right now, this line has been tested 3 times in 2023, 2024, and this year already. And now, if we have a strong move up, we might see a closure, a yearly closure after above this line. Well, that's the very long-term perspective. It's quite scary. And now let's have a look at the shorter-term one. This is a 20-year yield chart and the 4-hour chart. What I'm seeing here is a very strong impulse of the bottom, and right now a potential. This is wave 2. It might be already complete, and we are looking for a wave 3 being developed. However, there is a chance that this wave 2 will be extended here, and once it happens, we would be looking for a wave 2. However, if the yield, 20-year yield, takes the most aggressive path, considering this wave 2 complete and this is wave 3, it wouldn't be a big surprise if it rallies towards 6.4 in April, something just before the next Federal Reserve meeting about new interest rate. Let's see what happens. And now the final piece of the bond market discussion is TLT. So this was our chart and discussion last week when we posted our weekly review, and this is exactly what we said there. A strong bearish candle accompanied by an impulsive move downward would signal the start of a new leg lower, one that would likely take the price below the January lows, implying a potential loss of 8.5% or more. The risk of a bearish reversal is very high. This is exactly citation from our weekly report last Friday. This was the candle that was formed last Friday, and if we measure the drop, 8.5%, exactly as we forecasted. So even though it's bounced here, and right now the green closed Friday with a green candle, this candle is not sufficient for make a reversal. It's called a thrusting line, and it is viewed mostly as a bullish, as a bearish continuation candle. The same happens on the 3-day frame. This is a neutral bearish doji with lots of bearish signals, technical signals, which would support move lower. And on the weekly frame, we have a very strong reversal. The candle itself is an inside down, but if we look at the bigger formation, the last 7 weeks, it's technically a tower top and the confirmation of a tower top. A move lower has much higher probability at the moment. And now let's have a look at TLT chart. So what we are seeing here is, this is the chart that we've been tracking with our members for a while, since the beginning of April. So since April 7th, when we said that this is going to be a reversal here, so the TLT reversed and is moving down. And if we want to know what would be the bigger picture, this is our target. This is our perspective target for the next wave. Potentially this is wave 1, 2, 3, 4, and 5. However, there is a possibility of wave of A, B, C formation as well. In this case, I would be looking for a target between 81 and 73, somewhere here. That's the midterm perspective. If you are interested in the long-term perspective, the chart that we've been tracking since 2020, 2021, you're welcome to check on our website, investingangles.com. And we posted this chart in the recent weekly update. That's the perspective for TLT. And the final one is the message for my Canadian compatriots. Just a few days ago, on April 7, Canadian 5-year bond yield possibly completed a year-long ending diagonal, which started in April 2024 and formed quite a few waves. So there is a good chance that this diagonal has ended, and now we are looking for a very strong and sharp reversal, potentially bringing the yields, the rates, to 3.35 or 3.91 in a matter of just a couple of weeks. that's the perspective for the bond market, for the US bond market, and for the Canadian bond market. Today's discussion about the stock market, we start with Russell. This is the candle map, the candle closure on Friday. So what we are seeing here, a couple of things that are quite concerning. First of all, I'd like to emphasize this particular cross. This is 100 over 200 days moving average cross, which is most likely will happen on Monday and maximum on Tuesday. So far, the candles here, the build-up is neutral bearish, and in order to make a stronger move, Russell Bulls needs to work really hard. If we look at the weekly candle closure, it is a thrusting line combo, and it is viewed as predominantly bearish. The chances for a move lower are significant. Another candle, this one, that closed on Friday was a 10-day frame, and this candle is a clear bearish continuation candle. I'm not seeing anything bullish here. Well, it might develop in the next 10 days, but so far there is none. And this is another concerning data point. This is the 15-day candle, 15-day closure, which will be done on Tuesday. 2 days left. In order to make it somewhat less bearish, Russell needs a very strong rally. In the next 2 days, it would need to rally at least almost 7%, and if it thinks about making it bullish, it would need to rally about 13%, which is kind of impossible at this moment. And also, I'd like to point this, that a particular 8 by 20 EMA bearish cross, which already happened, but it needs to be confirmed on Tuesday. Let's see if it holds. So far, the candle perspective is quite bearish. Another chart here, this is the MACD monthly chart. This is something that we outlined back in March, saying that 1800 to 1400 would be the target. So far, Russell dropped to 1697, and it is right now getting support at the Bollinger Bands. If there is a possibility that it will move higher here, also finding support at the 100 months moving average, there is a possibility that this is over. However, I'd like to see a reversal signal first, and it needs to be confirmed. So far, Russell dropped almost 31% of the most recent top. And these MACD crosses are not simple to reverse. So let's see what else is in store. So this is the long-term projection. The last update on it was in January 5th. Since then, we didn't change the chart. And you can see that right now, Russell landed perfectly in the middle of this green rectangle. And we are looking for it as a potential either wave A of a bigger correction for wave 2, or the wave 4 can continue down. So technically, the wave 4 could drop as low as 966, which is 2000 low, and it would be considered a support at the wave 4 of a lower degree. That's the long-term perspective. Now let's have a look at the smaller chart. This is the chart that we've been tracking since November, when we said that Russell is about to form a top and move down. So far, the chart maintains all original elements, and you can see Russell already hit our target that we identified in November, and so far the wave has been impulsive. So basically, it is fitting both scenarios, either the green one with a lucky path. I would expect it to move a little lower here, find the bottom, and then make a very nice rally upward. Or if this was wave 5, and this is a very good potential because this is a all-time high here. This is wave 5, then we would be looking for an impulse like this, and it could be possibly a wave A of a bigger correction. So this would be A, B, and C somewhere down there. So far, that's the perspective on the midterm. And for the short term, this is the wave of the top, and we have all reasons to believe that this was an impulsive wave. If we look at the red counts, this could be very well an impulse. The first impulse here, wave 2, another impulse, wave 3, wave 4, and the final impulse, wave 5. And this would be wave A of a bigger degree. So far, the wave upward has been, I cannot say exactly it's been impulsive because it is still lacking some impulse qualities. So right now we need to see whether Russell could make a higher high and then a corrective wave 2. If this happens, then there could be a possibility of moving higher. However, we shouldn't forget that if even this is an impulse, this impulse could be wave A of a zigzag, potential zigzag for wave B. So this is the perspective for Russell. There are chances for moving higher. However, technically and from candles perspective, the odds are strong bearish, and we need to be very careful with the next moves. Now let's move on to the next one, and we'll talk about Nasdaq. This is the candle closure, candle map. What I'd like to say here is that a freshly made 50 by 200 days moving average death cross. Well, that's not a very nice event from technical perspective, and we would be looking for a move lower here. Speaking about, however, I would like to say that the daily formation is a tower top with a potential consolidation here and a continued move higher. The weekly candle is a piercing line, which is viewed as a possible bottoming pattern. However, we need to see a very strong confirmation next week. It needs to close above the high of this red candle from the candle's perspective in order to form a bottom. Another closure was here on the 10-day futures on Friday. This is a bearish continuation candle, and in order for reversing it, it needs a strong move upward. And Nasdaq will be forming its 10-day candle on the cash index on Monday. There are a couple of points here. First of all, if it closes below 18,799.20, it will be strong bearish, no matter what. In order to reverse it, Nasdaq needs to rally about 0.62% on Monday, which is very possible for Nasdaq. And not only possible, it's also a probable move. However, if Nasdaq is thinking about converting this candle into something bullish, it needs to rally about 4.5%, which is already a challenging task. Although it's still possible, we know Nasdaq can make much bigger moves in one day. Well, these levels are to watch on Monday. Now let's have a look at technicals. So this is Elliott Wave, a longer chart, something that we've been tracking for a while. And Nasdaq moved nicely into the middle of our target. And right now, I have more reasons to believe that this was wave A of a potentially bigger correction. Why? Because Nasdaq made a very dangerous move here. It crossed the high of November 2021, and technically it broke a very significant impulse here. So if we consider an impulse from the lows of 2020, this was wave 1, 2, 3, 4, and 5. So now we have waves 4 and 1 overlapped, and this is a big concern because now if it makes a higher high, if it moves higher, it could be a diagonal only, and it would be much worse consequences later on in a couple of months or maybe in the next year. Well, that's why the blue pass here is, I would say, it's a much better one for that perspective. We have a bigger correction here, and then we'll start a new wave. However, the targets remain the same. Now let's have a look at the next chart. This is the midterm chart that we started tracking in February, saying that Nasdaq has all chances to drop towards 19,600, but we were very optimistic that then. Right now, Nasdaq made as low as 16.4, and now it is trying to recover. So this is the latest update on this chart on April 8th. We said that this is the bottoming formation, so Nasdaq was very close to multiple very strong support levels from Fibonacci perspective, and this is exactly what happened. What we are seeing here is Nasdaq is sharply higher right now, but the only concern that this wave has been corrective so far, and this is I'm viewing it as a potential of a bigger zigzag for wave B. However, it could be only the first wave of a much bigger correction, and I'm talking about this potential. For example, this would be wave A of a bigger correction, wave B, and this is wave C, and only then it will be wave B. So this potential is also on the chart. However, it's indeed very challenging to project the path like this at this point. So we are keeping this for this one. If we look at the micro wave right now, what we are seeing here is that wave was been clearly corrective. This is potential ABC, and if Nasdaq makes another higher high, I would consider this as a wave C of a bigger bearish flag, potential wave A, and with a move down. However, I'd like to emphasize that this move could be quite significant. For example, like 8% Nasdaq could make easily for the final wave. So far, this wave is corrective, and it's interesting that it might go higher only as a diagonal. That's the working hypothesis right now. If this is indeed a diagonal and it closes higher than the point C, well, we will see a very strong rejection and the move down. And the final chart that I would like to talk about, Nasdaq, this is 15-day MACD chart, and the candles that are closing right now. So in March 8, we made an estimate that that Nasdaq has a chance to move sharply down, and the potential for a drop would be about 13,000. Well, so far, and this would be just an average decline from the similar crosses. Well, so far it is on track, and if we look at this chart, this is a monthly frame. Nasdaq made the monthly MACD bearish cross in the closing hours of March. Right now it is considered done, and now we are looking for a continued move down. So these crosses are not easily to reverse, and the chances for Nasdaq, I would say at least a couple of months or even maybe quarters of a bearish market. That's for Nasdaq. Now let's talk about Dow Jones and Dow Jones Transportation Indices. Dow Jones is in a better position compared to the other indices because it formed fairly strong bearish tower bottom on the daily frame and another bullish tower bottom and bullish engulfing here. However, I'd like to say that these moving average lines are heading towards the cross, and this is not a healthy move at this point. However, the short-term odds are bullish, and we might see a continued rally or a bounce higher. 3-day candle is also bullish engulfing, and I think in the next 3 days we might see higher prices. The weekly candle is a piercing line, which is also viewed as a bullish one. However, if we look at the 10-day frame, which is closing on Monday, in order to make it bullish, Dow Jones needs to rally about 3.8%. I would say in this case it will be less bearish. In order to make it bullish, it would need to rally about 5% or more. That would be the minimum requirement for a bullish candle. Obviously, this will be a very challenging task. Now let's have a look at the charts. Let me start with this one. So this chart was shared with our subscribers on December 8. We were saying that Dow Jones possibly completed an ending diagonal and it has a chance to return to 37,611.56. And now this is the same chart, nothing changed. We can see that Dow Jones breached through this level, and it makes me think that there is a good chance that it will continue despite the candles and especially on the shorter term frames. Well, that was a very nice call. Now let's move on to the bigger chart. This is our long-term frame, and this week Dow Jones made a very dangerous move. So it made an overlap similarly to what Nasdaq did with January 2022 high. And before I was considering a possible wave, impulsive wave like this. This would be wave 1, 2, potentially 3, 4, and going higher high, 4, 5. Now this potential impulse is broken because of this overlap, and we would need to consider in other waves. And this is now Dow Jones has much better chances to explore this blue rectangle and even going into the red one in the nearest future. And this chart we discussed way back in January at the beginning of the year. So far, nothing changed here. No change to the long-term perspective. Dow just made another confirmation for the blue path. Well, now let's move on to another chart. This is a short term. What we are seeing here, Dow Jones potentially made another impulse down. And if we break it like this, 1, 2, 3, 4, and 5, and the wave upward is corrective, similarly to what Nasdaq is doing right now. And I would be considering this as a wave A of a potentially larger wave B, or even wave 2. However, this would be a very strong stretch if Dow Jones makes this type of impulse. Well, now let's discuss. So this is the same chart I was looking, the 15-minute potential as a bearish flag. Now let's move on to the next one. So this is Dow Jones MACD monthly cross. And while Nasdaq and Russell made their crosses in March, Dow Jones refrained from that, but this is the first thing it did in April. And if it closes April with this cross, I would say, and by the way, this cross would be of a record magnitude, slightly higher than the one that Dow Jones made in 2022, well, we would expect several months of decline. So be prepared for this type of scenario. And the final one is the Dow Jones Transportation. The index is more bearish than the Dow Jones itself. We are seeing a freshly made 100 by 200 days moving average cross, death cross, which is far more serious than the 50 over 200. And the weekly frame is far from being bullish. This is most likely a thrusting line on the consolidating candle. And it has much stronger task for a reversal on the 10-day frame, which is closing on Monday. In order just to make it less bearish, the Dow Jones Transportation needs to rally about 6.2%. And this is the long-term frame. This is our initial call on November 14th when we said that the DJT is made a top here and it's going to be falling down all the way there. So this is exactly what it did, and right now it is closing to our target that we identified in February. So far the wave has been impulsive, nicely breaking into 1, 2, 3, and now I think we might see a couple of weeks of consolidation for wave 4 before making wave 5. If the transports reverses here, it wouldn't be a very nice move from the Elliott Wave perspective. So I would expect it to move lower below September 2022 lows. So that's the perspective for Dow Jones, and now let's move on to our main party, S&P 500. So what we are seeing from the candles perspective, another tower bottom and the potential for moving higher. So these could be viewed as a consolidation candles. Again, the 50 over 200 days moving average cross looming. So far, the 2-day candles failed to form a bottom, and another closure will be on Monday. It highly recommended to close above this red candle, which would require about 2.5% rally. Well, it's doable, but there will be challenges for sure. And the 10-day frame, which is also closing on Monday, it requires about 5% rally in order to make a somewhat neutral bullish candle. The 10-day on futures closed on Friday, and it was a bearish closure, no questions about it. Let's move on to the next one. This is a MACD bearish cross, which happened also like for Dow Jones, the first thing in April. And our previous estimate was that S&P 500 might drop much stronger towards 4,300 or losing about 30%. This was based on some statistical estimates. Well, so far everything is on track here, and now let's have a look at the sectors. So if we look at the sectors, there is no consensus here for sure. That financials closed with a bullish candle, the same for technology and industrials. Consumer staples also with a bullish candle. However, I'd like to say that all these require confirmations. Without confirmations, they might transform into a bearish continuation. So that's speaking about the healthcare about consumer discretionary, about utilities and energy. They are technically bearish continuation candles with the chances to move lower. So there will be some discussion, healthy discussion between the sectors on Monday, I would say. Let's see who gets better positioned. So far, it looks like technology and financials and industrials, three of them, they might get a winning hand. So that's the perspective on the weekly. On the daily frame, for the same sectors, I would say that most of them are bullish. However, I like to emphasize this particular one. This is the financial sector, and I already discussed it on April 10th. So what we are seeing here is that the sector is forming potential bearish flag. It might need another higher high in order to complete it, and then we would be looking for this reversal, and these are approximate targets for now. If financials make it a new higher high, we might need to adjust the targets. So this remains on the table and pretty much alive. Now let's have a look at the large caps. So the daily closure was technically bullish for almost all of them. And if we look at the weekly perspective, so very strong bullish candles for Microsoft, for Amazon, not so strong, but still bullish. Very strong for Nvidia, and Meta also made a bullish candle. Apple is looking for Apple technically is bearish. This is a thrusting line, so it might need a much stronger effort in order to pull the price above the red candle's high on the next week. And the Google is also bearish. It's not a bullish candle, and I'd like to say that Google lost the 20 months. Oh, this is a monthly candle. I'm sorry. So Google is bullish on the weekly. This is the weekly, the bullish engulfing. So I would expect higher prices for the next week. But once we are talking about the monthly for Google, so far this candle is bearish, and it would need to move much higher in order to make a reversal after this confirmation that Google initially made in March. Speaking about Tesla, on the weekly frame, it's a bullish engulfing, and the break above the 100 days and the 100 weeks and 200 weeks moving averages, there is a chance for a continued move higher. However, the trend is still bearish, and we see a strong rejection of the 50 weeks and the 8 weeks moving averages. So let's see which one wins next week. And speaking about the Berkshire Hathaway, it's let's have a look at the weekly candle. It's a bullish engulfing with a very good chance to move higher in the next week. Now let's have a look at the Elliott Waves. This is a short-term perspective. What we are seeing here is this is potentially wave A, B, C of, and I would consider it as a wave A of a bigger correction based on some technicals and candles. And this wave upward has been corrective so far, and I'm looking at it as a wave A, or maybe another wave of a lower degree. Let's see how it develops here. And this is all right. So this is the short-term chart, 15 minutes. I am seeing it as a potential bearish flag here, whether it's wave C or wave C is being developed, and this wave of the bottom on April 10th, so far it looks very corrective, and I'm looking at it as a potential ending diagonal. It could be this one, or it could be an expanding one, like I said here in red, for example. Well, so far we are looking for this continuous move higher, and this would be an ideal target, 5680, 5470. If S&P makes it to that high and makes a strong reversal, then it would be the potential beginning of a very strong wave downward. And this is the large perspective, something that we outlined way back in January 11th. So far, nothing changed here. The target has been perfectly hit for the potential green count, 1, 2, 3, 4, 5. However, I'd like to say that this is a very dangerous level. If S&P continues lower and breaches this level even one basis point, that will be, this green path potential will be invalidated, and we would be looking for a purple one. And the final discussion here, I'd like to give you a global perspective. So what the other indices are thinking about the next week from the candles perspective. So I'd like to say that Nifty, Australian Index, ASX, Germany, Canadian TSX, UK, Japan, they are all bearish. So these candles are not reversal ones until they confirmed. And I would say that they are most likely in neck on neck patterns. Germany and Canadian, they're thrusting lines, UK is thrusting lines as well. An interesting discussion here about the Chinese Shanghai index. Technically, this is the weekly candle, and it could be a reversal, could be. However, if we zoom out and look at the 8-day frame, which also closed on Thursday, this gives a quite different perspective. So first of all, we see a strong confirmation of a bearish move here. So this was the green candle, it was a inside down, and this red candle was a confirmation with breakage through multiple support lines. So I would like to say that this index has much better chances to move lower. And the similar situation for the Hang Seng. If we look at the weekly candle, it could be a bullish one. However, I'd like to say that a breach through multiple support levels, and again, if we look at the 8-day closure on which happened last week, this was a very strong tower top. And this candle, the next one, which is closing next week, could be just a consolidation, and we might see maybe 1 or 2 or even 3 of them before the next move lower. So I would say that both Shanghai and Hang Seng are bearish at this moment on the midterm frame. We can see some bounce or even a short-term rally. However, the chances for reversal and the move lower are significant. Now let's talk about special features of the day, and we will start with a deep dive into Microsoft. So Microsoft, if we look at the candles, everything looks very nice and green and bullish. So far, this could be a bottom, strong bottom on the daily frame. On the weekly frame is a strong bullish engulfing. The 10-day has a very good chance to form another bullish engulfing, further increasing bullish odds. However, the problem starts with bigger frames when we look at the monthly frame and particularly on the 2 months frame. So this is something that many people would probably ignore, but let's have a look at this particular perspective. This is MACD cross, and I think I have a special chart. Yes, let's start with this one. So this is the monthly cross, which happened way back in November, I believe. Yes, in November. And this was the trigger that we said that Microsoft is going to be bearish for quite a long time. And it indeed, it happened, and Microsoft is right now moving down. However, I would like to say that Microsoft decided to escalate bearish odds in this particular development. And if we look at the 2 months frame, this is a looming MACD cross on the 2 months frame. If we look from historical perspective, so these cross happened only 3 times, before. And let me show you better. So the first one was in 2022, which led to significant decline. Another one was here. This is year 2008, and another one was here in year 2000. So these were 3 crosses, and right now we are looking for the 4th one. Technically saying, this cross would put the current correction in line with these 3, the one in 2000, year 2000, 2001, year 2008, 2009, and the one in 2022. And speaking about this, right now I had an statistical estimate for the monthly cross, and was looking for this particular price, target price for Microsoft, 285. However, it looks like we would need to run another statistical estimate on the 2 months cross if it happens at the end of April. And it would be quite a different picture, because if we remember that, for example, Microsoft just in year 2000, I think it lost about 75% over the period of 9 years, I believe. Yes, 75% loss starting in the year 1999 and ending in March 2009. That was quite a ride. So if we factor in this particular cross and the other one in 2009, well, we might have slightly different picture and slightly different expectations for Microsoft. Now let's have a look at the charts. Not Elliott Wave, this is the head and shoulders, potential head and shoulders. So far, Microsoft is working nicely on this chart, which we identified back in October, saying that this is the potential for Microsoft, and it looks like Microsoft likes these types of charts. So the head and shoulders in 2022, and as we see, it breached down, then it moved up above the neckline and then made a final wave down. This looks like it's happening right now, so it's a challenge for the neckline. We'll see if Microsoft moves a little higher and then finally drops here. Well, this won't be aligned with our expectations from the MACD estimates, which is 282, not that far away. Now, if we look at the bigger chart, something that we discussed way back in October, saying that Microsoft is topping up and now has a chance to move down. So the chart right now, it's approaching our target, 341, very close. Let's see if it moves down. And speaking about the short-term frame, this is the chart, the finalized chart on December 18. So far, Microsoft has been moving down, and I would like to say that this is potentially either wave 3 of a bigger impulse or the end of wave C, which is also a possibility here. Let's see how the next wave is developing. So in order to make wave 3, it needs one more wave down. But if it continues to move higher, it will invalidate couple of potential impulsive waves, and I would be looking for a correction, something like this. This would be an A, B, C of another wave. So this would be, in our case, wave A, and we would be looking for wave B somewhere here. So it's not clear at this point for Microsoft, but I would like to say that all eyes should be on the final day of April, when it has a chance to form a MACD bearish cross on the 2 months frame. It would be a very significant one. And the final talk today is about JP Morgan. Let's have a look what we have here. So this is the wave that the stock made since the middle of February, and right now it's a corrective wave, potentially zigzag, and wave B followed by an impulse. And I am considering this as a potential for wave A, and this would be wave B after a bigger corrective. Oh, sorry, wrong one. So this would be wave A, possible wave B, and wave C of a flat or a zigzag at this point, or could be even a triangle. Well, that's the possibility. And if we look at the bigger frame, a bigger chart that we were looking for JP Morgan, at this point there are two paths clearly on the table. One is the blue one. I think this is the lucky one, which would be wave 4 here. After this wave, another one, and moving upward higher. Or if it breaks below this blue rectangle, I would say, especially if it breaks below 172.96, then it would be wave 2 of potential wave 2 of a super cycle. And what kind of support we have here for JP Morgan? The weekly candles are bullish. However, it requires a confirmation. So far, the trend is bearish, and I'm kind of skeptical about this. But if we look at the 10-day frame, the JPM needs about 4.4% on Monday, to make on Monday, in order to avoid bearish closure on the 10-day frame. So that's quite a significant task. And another chart that I'd like to share here is the statistical MACD estimate that we made recently on March 15th. We were saying that JPM formed the MACD bearish cross on the 10-day frame, which is a very significant event for the stock, and the cross was of a record magnitude, 60% higher than the previous one. If we factor in the magnitude here and run some statistical analysis, our expectation for the stock to land somewhere between $160 and $100 in a couple of months, quarters, or even years, depending on the pace of this decline. And I'd like to say that one drop below 172.96 would be a very strong move. And just to get back to this chart, it will invalidate the blue counts here, impulsive, and we would be looking for wave 2 of a super cycle. So technically, this wraps up our today's presentation, and I'd like to summarize. From volatility mixed signals to the S&P 500's critical Monday test, this week's wave map is full of decisions. Bond yields are pressuring the Fed. The dollar teases a reversal, and global indices are sending whispers of their own. We charted the Russell's crossroads Nasdaq's damage and Dow's depth. The Baltic Dry is talking, and we are listening. Microsoft and JP Morgan, we broke them down with precision. If you are done with noise and ready to trade with structure, timing, and edge, join us at investingangles.com for full candle reads, Elliott Wave maps, and multi-frame setups. Drop a ticker in the comments, we might chart it live. Thanks to our growing family, over 15,000 sharp traders, your support fuels every wave we chart. Like, share, subscribe, and ring the bell because timing is everything and the turn waits for no one. Until next time, stay sharp, stay objective, and remember, at Investing Angles, we chart the turn before the herd even blinks.